Okay, well, let's get started. Welcome everyone. Just a couple housekeeping items. We've got Q&A at the bottom, so if you have questions along the way, please drop them in the Q&A. Greg and I will be monitoring those, and we'll either answer them as we go or we'll answer them at the end. We'll try to get to as many of those as possible. We are recording this, so we'll post this out on websites and social media, etc. If you miss a piece of it or want to rewatch it. I'm Owen Bondurant. I'm a partner at Independent RX. We are a company that helps people start, buy, and sell their pharmacies. We also provide full accounting services for pharmacies. And today we're going to talk about the changes to the SBA and what that will mean to you if you're buying a pharmacy. And luckily, we were fortunate enough to have Greco join us from Live Oak Bank, and I'll let you introduce yourself.
Thanks, Owen. Thanks, everybody, for joining. Excited to share some of my thoughts about these meaningful changes. My name is Greco de Valencia. I am the Senior Loan Officer and Vice President of the Pharmacy Lending Vertical at Live Oak Bank. And I have been at the bank for 8 years now. I've been in the pharmacy and healthcare industry for almost 15 years. And always get a lot of joy about helping people achieve the dream of ownership, be it their first one or their fifth and 10th one. We run the gamut. We primarily do a lot of financing for acquisitions and expansions, but we also do working capital, commercial real estate. So if someone's looking for rent replacement, and we will do some refinancing as well. And we pride ourselves in really understanding the pharmacy space, deeply entrenched, and also doing a lot of continuing education and outreach so that individuals can understand the rules and regulations when it comes to financing. And that's part of what we're going to be talking about today. Some really meaningful changes with how to achieve that financing goal of an acquisition.
Yeah. Oh, great. And we're really happy to have you, Greco. And again, Greco's done a few of these with us, and we're
Mhm.
fortunate enough to get some of his time to go through this. So you mentioned meaningful changes to the SBA, their standard, their SOP.
Yeah.
Um, and most people probably think like, well, it's a lending program, it's a bank, like making changes. What is this all about?
Yeah.
Well, in my understanding,
What's exciting about that, right?
yeah, this is going to get real thrilling. We're talking about government regulation changes
Right.
to banking.
Yeah.
That's what we should have done as a topic.
I don't think we would have got many registrants then.
No. So, but believe it or not, the SBA does make changes, and they actually make changes, my understanding, fairly regularly,
Yeah.
annually. I mean, but most of them are pretty minor, right?
Yeah. Yeah.
But
There'll be some minor changes.
every few years they make some significant ones, and
Yeah.
this has occurred basically at the beginning of this year.
Yeah.
Um, and I think we wanted to do this as a topic because from my understanding is that some of these, I don't even know how to say this, make it more flexible for the
Yeah.
lender, and for those who are trying to get money. Um,
I would agree.
so to you, what is we probably can't go through every change, right? So to you, what where should we start? What's the big change in your mind that occurred that people need to know about?
Yeah. Well, let's start first with everybody, kind of giving everybody a highlight a little bit about some of the topics and the people that and the things that we're going to be talking about. So
Yep.
one is the SBA product, right? Why SBA? Why is this talked in and intertwined with pharmacy? One of the big reasons why is because the Small Business Administration has a loan product that banks can use through the 7A loan product, and it can be used for acquisitions, working capital, expansions. And the reason why it's been so, I would say, used often in the pharmacy space is because pharmacy is all goodwill, really a majority of what you're buying. It's all free cash flow. It's the value of the scripts, and there's no real tangible collateral that's out there. And so the SBA program allows for lending decisions to be made off of those cash flow, right? So that's one of the big reasons why first it's so meaningful to understand, because when changes are made to that, it can impact how a majority of small business owners, especially pharmacy owners, are receiving financing from a bank.
And this is an important topic. I mean, it's funny you say that. I mean, even when we first started doing our own acquisitions of pharmacies, I can say that it's been like 24 years now. It seems like yesterday, but 20, 24, 25 years ago, like there wasn't getting loans for pharmacies. Like
Yeah,
that wasn't
yeah,
we
yeah,
lended all of our money from wholesalers and from
yeah,
anyone that would give us money. And
yeah,
so, the SBA was around, but banks like Live Oak weren't around that understood the pharmacy industry.
yeah.
And then they started putting this SBA product. And I mean, it made it 100 times easier for us to acquire.
Yeah.
So it's a huge product and really important to the industry, actually.
Yeah, we've been happy to help. I mean, I've even lost track of the numbers now of how many people we've helped get into it. And it's not a perfect program, and I'll be the first one to kind of admit to people that there's pros and cons to it. But for a
Yep.
majority of the individuals, especially those who are looking to purchase their first, second, or third store, the program is pretty meaningful. So
Yep.
the next thing is, you got to get through the first hurdle, which is meeting an equity down payment requirement or equity requirement. And the SBA has laid out that equity requirement is 10% of the total project cost. So that word equity gets thrown around a lot in it, kind of interchanged sometimes with down payment. But I think it's important for everybody first to understand that equity is either cash that a new buyer is putting in, okay, into the business, into
Yep.
the project. Equity can be also in the form of sweat equity, right? And it can also be in the form of a seller note or seller financing. And all those can kind of become into play in order to meet this equity requirement, which is 10% of the total project cost. And
Yep.
historically, how that was calculated has gone through a lot of different iterations, right?
Right.
At one time, it was 25% of the total purchase price requirement. Then it had a meaningful change, probably about, I would say, 5 years ago, 6 years ago, where they said it's 10% of the total project cost. And how that was could be made up is either entirely by the buyer coming in with it, or at least a minimum of 5%, and then the remaining 5 could be held on a seller note on full standby. So there's another term that I think we ought to talk a little bit about: full standby. Standby on a note either means partial standby means that a certain amount of payments are on pause, and you can have partial standby or full standby. And so that's another important term for a lot of individuals to understand. Um, and now they've
Maybe
changed
talk,
again.
can we maybe talk through an example of this whole equity thing? Like,
Yeah,
maybe so people understand, like, what does 10% in dollar terms
yeah,
mean,
yeah.
right? Like, so if I go buy a pharmacy for, let's say, I'm making up a number here, 800,000 plus inventory.
Mhm.
Like, am I putting in 80,000 or is it more? Like, could you maybe just
Yeah,
like talk
sure.
through just so we have an idea of how much money? Because I think coming up with this cash injection can be hard.
Yes, exactly. And I
Yeah.
think we'll do
Yeah.
that. And then that dovetails really well
Okay.
into what these meaningful changes can do. So
Yeah.
let's say, for example, that you've got, just for some easy math numbers, let's say we have $1 million project cost. And how you make
Okay.
up that project cost is, let's say you're buying a pharmacy for $600,000 goodwill. Okay. That's what the intangible assets are valued at, $600,000. So you're buying the inventory for 200,000. There's 8, so 800,000 total purchase price. And then you're going to need another $200,000 that make up from working capital and some whatever soft costs are associated with closing the loan. So you've got $1 million total project cost. So 10% is calculated off of that million. So in this example, it's going to be 100,000.
Okay.
So we sit there and think about like, okay, $100,000. I've got to come up with $100,000. How do I do that?
That's a lot of
And
money, right?
that's a lot of money, yeah.
Yeah.
And this is where the changes in the program have become meaningful, right? So now what the SBA is saying is, listen, there's a few different pathways to reach this 10%. And the first one is that the seller can provide all or part of the required equity injection with a seller note on full standby for at least 24 months. And the seller note cannot have a balloon payment. So what does that mean? So let's use for an example this, Owen. Let's
Okay.
say that you are a staff pharmacist and you've been in the pharmacy since you've got out of pharmacy school and got done with your rotations, and you've just been an integral person in that business, growing
Yep.
non-PBM revenues, doing whatever you might be doing, right, to really get the business stabilized. But the fact of the matter is that you just don't have this 100,000, right? You just don't have it. And it doesn't mean that you haven't been putting in a lot of sweat equity into the business. But now you seem like, man, the 100,000 is just daunting. It can't be done. And I think historically the seller might say, well, I'll just finance the whole entire thing, right? Well, now what one of the rules is saying, one of the pathways is saying is that, okay, the seller can now essentially make up that $100,000 in the form of equity, right? Form of seller note. But whatever the payments are has to be on full standby for the first 2 years.
Okay.
And then regular repayments can begin, but there cannot be a balloon payment. And all a balloon payment means is, all right, after those 24 months, I want to get paid my money in full in 2 years. They're saying you can't do that. So in that example, if the cash flow supports it and the story makes sense to the lender and the lender feels comfortable leveraging this pathway to ownership, there's now a way for someone to get in there, right?
Yeah, and that's huge because I mean previously for any of a seller note to count towards the cash injection, it had to be on standby for the length of the
Life of the
loan.
loan.
Life of
It
the
had to
loan,
be
yeah.
life of the
Okay.
loan. It had to
Yeah,
be.
so
But that's no longer there. So it's
yeah,
it's a it's a I always get careful about saying win the term win-win, but it kind of becomes a little bit of a win-win on the first pathway, okay? So
right.
so there's the first meaningful change,
Yeah,
okay?
that's huge.
Yeah. Now, the second option, if you want to call it that, towards meeting this 10% is the seller note can be on partial standby, and that means interest payments only being made if at least 25% of the required equity is coming from a source other than the seller note, okay? And the historical business cash flow supports the ability to make those payments, okay? So what that means basically is this. So the 10, if let's say the buyer says, well, I can make 2.5% of the 10%. Well, if you meet that threshold, then the remaining 10% can be on a seller note, coming from a seller note, but it can be on partial standby, so interest payments only.
Okay,
So
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 if
there's
we have
so
that
there's
hundred
another option.
thousand, if we have that 100,000, if me, the buyer, can come up with 25,000,
Yep.
then the rest of it could come from the seller note. And it doesn't have to be on full standby. It can be interest only or what have you. That am I
Yeah, yeah,
correct?
yeah. Interest only payments,
Okay.
and so there's another, there's
Yeah.
another pathway, right? There's another door
Because
that opens there.
I mean that's a realistic situation right there because a
Yeah,
lot of people may have 25,000. They just don't have 100,000.
yeah, yeah.
Yeah.
And I think then, we can't forget that the the full 10% coming from the buyer is still on the table. No one's saying that you can't do that. Like, so if someone just says, listen, I just don't want to take out that much leverage, I'm going to put the full 25, the full 10% down. Or if the seller says, listen, I don't feel comfortable doing those, the full 10% is still there, but now you've just got these other options. And I think what it really highlights, Owen, is these changes are there for the bank to use and leverage, right? And I don't mean just Live Oak Bank, I mean any bank, right, that uses the SBA program. But it really highlights now that every single person's situation and the acquisition that they want to buy, it has their own, little unique fingerprint, if you so to speak, right? And you really have to make sure that you're picking the right lender who's going to be able to either leverage these changes based on that situation or not. And so that to me is what a big thing that it highlights is that, now more than ever, it's really critical to talk to a lender that A, understands the space and your situation and how the cash flow and how you can get through some of these doors.
Yeah, no, I would agree. Um, I think what this does is if you're open-minded and you find the right partner to work with, there is a way for you to buy the business. Whereas, I mean, even a month ago, the answer a lot of times was, I don't have the money. And so, we can, you as that buyer, you know, if you work with the right lender, can come up a way to make it happen potentially. Now that assumes that the cash flow can support all of this, right? We don't want
Right.
to, I mean, you and I have talked on, I think last year, I think in all two or three webinars, we brought up the word leverage. Don't over leverage yourself.
Yeah.
Yeah. So, I mean, the cash flow has to support all of this, but if it does, it gives you a lot of flexibility to make this happen.
Yeah, that's a really important caveat here is that so everybody has to remember that the cash flow of the business is the primary source of repayment that any lender is looking at. Any lender that's leveraging the SBA program, in my opinion, correctly, that is the primary source of repayment. So if you're right, I mean, if we're taking in all these factors, which essentially is, adding more debt to the business because you're leveraging that cash a little bit more because maybe you don't have that full 10%. But if that cash flow is thinner and thinner to repay the debts, then it becomes a more challenging project to do. So you're right. There's that caveat there that people need to keep that in mind. And then the other thing they need to keep in mind too is that, you have to understand the lender's credit box. They have to understand the credit philosophy. You
Yep.
know, we have everybody, I think, has to be careful about if you do a situation where you are not putting in equity into a business, right? But you have to kind of think about, like I went back to that situation with regards to sweat equity. If you've been doing a great job growing the business and you just happen to not have the cash because of, whatever your situation is, you have to be able to speak to someone to see if there's a pathway to ownership. And I think that's what these new changes create, just more flexibility.
Yeah, no, this is great. I mean, for those of you, if you've never looked at doing this before, I mean, this is a huge change and can allow so many more people to buy
Yeah.
pharmacies than previously. Because I mean, let's be honest, as a pharmacist, let's say you're 30 years old. I mean, you're 5 years out of school, you've got student loans, you may have bought a house, like, just to live, like you're using up some cash. So it's hard to
Yeah.
build up $100,000 in 5 years. Like, so, this is absolutely huge for people.
Yeah.
Okay. So is there any other equity related changes that
Yeah.
you're okay?
There
Okay.
is. There is actually.
Okay.
And it has to do a lot with partner buy-ins. Okay. So So historically in the pharmacy space, there's always been a market for partner buy-ins, or what, we call them junior partnerships in our industry, right? But the SBA program has never been eligible for that. So it's been pretty hard for people that want to do junior partnerships. They either have to do like a sweat equity buy-in, they maybe have to take out personal loans, money from family, whatever it might be. Well, another important change now is that the SBA allows for partner buy-ins. So you can use the SBA program for a partial change of ownership. They made it eligible, sale of a partner ownership in a business. Loan proceeds can be used to fund the purchase of a portion of one or more owners' interest in the business and the business itself. Um, so that's a big change. So what that kind of means for everybody, let's sketch that out. So let's say, Owen, you own your business, own it for a long time, and you're ready to exit out, but you're not maybe really ready to fully exit out. And I've been a valued employee for a long period of time. Again, we're talking about this pathway to ownership, and you want to have me buy in. Well, I can now do that. Now there's some fine print with regards to who guarantees the loan and how that's viewed, which we can get into. But let's talk a little bit about now, well, what about the equity injection? Okay, how is that calculated? So, and I want to kind of make sure I don't lose a lot of people here and confuse it with the total change of ownership. But you can have now 10% of the total purchase price, which is, of the percentage that you're buying. That's what you're looking at. So again, let's take this example here. So, we're buying our business for, let's say, easy math, $1 million, right? And that $1 million is, let's say, 85% of the business. So the actual book value of the business is higher than that $1 million, obviously, because
Yep.
I'm only buying 85% of it. But 85% is valued at $1 million. That's the purchase price for the 85%. The 10% is based off of that now. So not the project cost, the purchase price. Okay.
Okay.
On the 85%. And the lender can review the existing business's balance sheet and their debt to worth in tandem with the buyer, the new 85% of the individual who's buying in, personal balance sheet, to determine what the down payment is and how to reach that 10%. So again, more flexible options. And now here's where the rubber hits the road when you get into the question about, well, what's our borrowers? Who's guaranteeing this loan? The major sticking point for the individuals who are post-transaction is anybody that's 20% or more has to guarantee the loan. So in my example, 85%, I'm buying 85% of your business. You're going to be below 20% post-transaction. You don't have to guarantee the loan. I do, obviously, because I'm above 20%. But let's say I'm only buying 60%. You're going to retain 40% ownership. You're going to be on guaranteeing the loan, unlimited personal guarantee on the loan, because you're greater than 20% post-transaction.
Okay. But I mean, I don't know about you, but we hear this every day,
Yeah.
right? So we get owners who are like, well, I still want to be active, but I don't want to
Yeah.
do the day to day,
Yeah.
or maybe I can scale down to 2 days a week and then do some management stuff, or still go to trade shows and try to
Yeah.
yeah, those kinds of things. So like, I mean, I can't tell you how often we hear this, and frankly, I mean, in some cases it's good for the buyer because now they've still got this kind of partner who's teaching them
Right.
the ways to learn the business and really do these things, and you're both kind of vested in it. So that's a huge change. I mean, that's never, from the time
No.
I've been doing this, I've never seen this as an option.
Yeah,
Uh,
no, it never has. This was one of those other meaningful changes. And again, I mean, we keep going back to this term flexible, with the concept and the goal of pathway to ownership, you just have more options now. So now
Yeah.
more than ever, it's important for sellers, buyers to think about, hey, what are the pathways? What are the options that work best for everybody and in the best interest of the business to keep the business independent? And the lender, has the flexibility now to choose if it feels that it's prudent within their credit box. And I think it's exciting. I mean, I think I know there's a lot of noise and a lot of challenges right now in 24, but I do think that there's a real healthy appetite for ownership and for owning. And I just felt like it was important for everybody to understand that there are these options, and it's important to talk to a lender that understands them.
Yeah, that brings up two things for me, Greco, is I mean, eh, like when I went to buy my dad out partially, we had one option. Well, no, actually we had two options. I could pay him cash,
Yeah,
um, or we can do a seller note. Like that was it.
yeah,
I mean, there was no other option. I'm
yeah,
sure my dad would have liked to just get money,
yeah,
cash. I mean, right? So I could have done this in a different way, which would have gotten him money, but also allowed him to continue, which he still
yeah,
does, operating in the business.
yeah.
So I mean, I can totally relate to this, and I think so many people in family businesses or PICs, I mean, this is just something that comes up every day and will really allow a lot of these legacy businesses to continue on under new ownership. Um,
Yeah, I mean,
and yeah,
exit planning is something that I think every owner should be thinking about, at least as a horizon. I mean, a really bright individual in this space who I respect a tremendous amount used to always kind of liken it to retirement planning. I mean, I don't think there's any prudent person with good business acumen that would say that if you're working, you shouldn't be somehow thinking about retirement, even if retirement is 30, 40 years away, right? You want to prepare for the future. And so I kind of always have agreed with that, is that you have to kind of be thinking about, is there an exit strategy there for me as an owner? Is there a entry strategy there for me as a potential buyer? The last thing you want to do is run into a situation where it's a fire sale, or, oh my God, we got to cobble this thing together in a month. And so, these changes add to that conversation. I know you probably, as your group, you guys are talking to sellers and buyers all the time. So
yeah,
important to have
no,
a conversation.
I also think that people have it in their head with these assets. Like this is just one of your assets. You've got, you know, investments, you've got maybe real estate, whatever. I mean, this is just one of your assets. And I think people think, okay, well, I'm just going to sell this at 65. One day, done. Well, what this is saying is maybe you can do this over a 5-year period,
Good.
or,
Yeah.
like you don't have to, you can ease into this retirement rather than, and my dad actually loved that easing into it. Like he was like worried, like, what in the world am I going to do when I'm done?
Yeah.
And so what this allowed him to do was kind of back up and then back off and then back off and actually he's still working once a week and like because so I think from a seller's perspective this just gives you a different way to think about it and start planning now versus hey, next year I'm going to sell. Maybe you can work your way into it.
Yeah.
uh,
And it's not to say that one,
is
full
better
change
than
of
the other.
ownership,
Yep.
partially. It's not to say one
Yep.
is better for the other, but it's just part of that. It just adds to the conversation, and I think it adds more options for people as they're looking to keep the business independent if that's what they want to do.
So the other thing you mentioned is that there's an appetite for people to buy and to sell because of changes in particular that have occurred this year,
Yeah.
2024. You want to maybe just give some context around that comment and because I think it's important to not necessarily the lending, but just the reason for the transactions
Yeah.
and yeah, in general.
Well, so, I think we all are aware of the reimbursement challenges that are out there right now. And, it has been an erosion, a decline. I think we have to call it what it is over the many years. And I think, we're aware of that. But so we're very sensitive to over leverage. We're very sensitive to making sure that the project makes sense, because we want someone to be successful and we want them to be able to pay us back. That's the goal, right? And there's always those unknowns, the reimbursement changes, facilities can leave. I mean, there's all these different things that can happen that we need to that I think impact it. But I just was speaking to an individual yesterday in Louisiana who was, you could hear he was done. He was ready. He was tired of working for the chains. He really wanted to do something different. He had all these ideas. And I think that's part of it, right? I mean, I think we've got a situation where, you hear about all the noise going on in the chains, the walkouts, the lack of staff help. So they're under immense pressure as well. And I think you have people that are having a desire to want to go and do something for their own. I think there are a lot of individuals out there who have ideas about how to drive non-PPM revenues, have ideas about getting into compounding, clinical services, who have a real, desire to kind of push these other levels. And I think if you have those, you need to be able to get into a store and own and grow them because viable. They're viable solutions. I mean, we see them all the time on social media. Kyle McCormick, Blueberry Pharmacy, does a
Yep.
great job on his cost plus model. Ripple Patel, Save on RX, he has a great program as well to help implement a cost plus, cash discount card. I won't say his name out loud because I don't want a lawyer to come knocking on my door. But there's a maverick out there who's invested a lot of money in that model. So it's there, right? And I think you just have to have that entrepreneurial spirit to accept the fact that there is some challenges, but that if you want to own and you have the right opportunity to own, that there's an appetite to still do it. I think we got to get through some of this noise in the first quarter of 2024, and lenders are going to be looking a little closer at those financials. But
Yeah, so
there's still
that makes me think of, well, two things, and then we'll get to some questions. But one, yeah, you know, the opportunity to own a store, a lot of these stores that are selling have been in the same hands for 20 or 30 years. Nothing wrong with that. That's great. But I mean, the market's changing and it's changing very fast. Um, and so, things like testing and remote patient monitoring and diabetes education and all these vaccines that you can do, like, more and more of this is going to get pushed to pharmacies. There's a shortage of doctors. They don't have time to do this stuff. It's got to go somewhere, and it's going to pharmacies. The good news is like I teach a class at a university, and that's what the students are interested in is the clinical stuff. They want to provide, you know, their clinical expertise to people. And now we can actually make money on it. Actually, we can make more money. So I think there's just a huge opportunity, like you said, if you have the entrepreneurial spirit to go after stuff.
yeah, yeah,
Now, there are some real challenges,
yeah.
and the reason we have to add all these things is because
Yeah.
of the challenges. So, how is the bank looking at this? Like, how are they going to process all these changes? Like, from
Yeah.
your opinion?
Well, I mean, the banks and frankly anybody who's doing an acquisition value and has always looked at historical cash flows and trends, year to dates. I think Now more than ever with the some of the things that I've heard out in the space with some of the reimbursements on certain plans, particularly around the brands, the double DIR fees that we just have to get through here in the
Yep.
first, 3, maybe 5 months.
4 5 months,
We
yeah.
gotta get through that. But I think there's going to be a little bit more of, like I said, a look at what are some of the recent, meaning first, let's say first quarter financials. What do those look like? We understand that the noise in the beginning of January with just the pricing changes that can impact things. But there is going to be a little bit more of a view on that. And so we just want to be aware of what's going on there. And so I think individuals who are looking at that, just be prepared to have kind of an overview about what that might look like and have those meaningful conversations with the lender because, you know, um, it's a meaningful change. I mean, DIR fees are coming out up front on a point of sale system. I've heard mixed reviews of that and
Yeah, so have I.
implementation of it. And so we just have to be aware, because the historical cash flow is meaningful, but I think in real time now more than ever, it's important to look at things.
No, that all makes sense. And, if I were any owner, and I don't know how much this matters to the bank, I mean, have a plan.
Yeah. Oh yeah.
How are you going to change? What are you doing, to, change this business or to add on, change the wrong word because you're probably buying a decent business, but like, what are you doing to sustain it long term?
Yeah.
Uh,
Yeah. I had dinner actually last week with some thought leaders in this space, and the conversation of the question about how do you grow gross profit per script. That's kind of what is an important topic. And I think, you have to ask yourself that in not a thing of like, oh, it can't be done. And that's okay. Maybe it can't in that certain situation. And that's a good question and plan as well. Listen, I don't think it can be done. I think we are where we are. Okay. Well, then that helps you assess the situation and helps the buyer, seller, bank, everybody value that opportunity and assign where's the risk level, where's the debt service, where's the wiggle room that we need to bake into this. And it also
yeah,
gives someone a good idea about their overall business plan, what they can do to it. Is it going to be something that they can grow or not?
yeah, no, that is absolutely it. Can you change the gross profit per prescription? If you can't, can you change the gross profit per patient?
Yeah, yeah,
Right?
true.
And look at what all you can sell to them individually. So no, that's great advice. That's good stuff. We've got our share of questions here.
Sure.
Um,
Let's take them.
I'm going to throw them out here. If any of them are too complicated, just say so.
Got it.
So it says, what is the buyer's credit score required to obtain these kinds of loans? Now I
Great
know,
question. Great
yeah,
question.
it's not a black or white question, but I don't think,
No,
but
it's not. But typically there's you'll hear out there the 5 C's of lending and cash flow being one of them,
Mhm.
and credit is another one. I would say that I'd give everybody a target of 700 or better, but to your point, it's not a black and white. There could have been life events that have occurred that have caused your credit score to maybe not be as high. But credit score is important. The higher the better, obviously. I myself use Credit Karma. I'm not endorsing them in any way. That's just what I use to monitor my credit and to kind of keep a good eye on anything that might be happening. And so I encourage everybody, there's plenty of free ones out there. Use them, monitor them, be ready to have that discussion if there is a red flag out there on your credit. Tackle it early with the lender so that you can understand whether that's going to be a rate limiter or not.
Okay. Okay. That makes sense. Yeah, great. Um, this one, we see this situation a lot. So,
Go ahead.
this person says theoretically looking at a poor cash flowing pharmacy,
Hmm.
um, believed to be because of just poor management and
Hmm.
not adapting to the changes over the
Right.
last few years.
Right.
Um, you know, does that mean that this loan is not eligible? If it's based on projections, is there a path kind of,
Yeah.
to me, it's probably case by case here, but Yeah.
Yeah, I mean, obviously, going back to my comment earlier about how the primary source of the repayment at the time of the loan either being approved or funded has to be from the cash flow of the business, okay? So if it's been a poor cash flow business and we're adjusting the recasted expenses or the adjusted EBITDA, if that's getting adjusted and it meets what the loan amount is being proposed, that's the goal, right? Now,
Yep.
if the new buyer is saying, "Hey, listen, here's all my projections, and I've got these great ideas about how I can, improve," um, then those will get married together. But if the business is being asked at a price, even after you've adjusted the cash flow, and it's not working, well, it doesn't matter what your projections say because now the business is essentially being asked for a loan amount and a price that cannot be serviced even as is. And so I hope that answers the individual's
Yeah.
question, but
I mean, my opinion is the price has come down,
yeah,
right? I
yeah,
mean, it devalues the business. Like, so you may fill a lot of prescriptions, but if it's not run right, it doesn't have so there's probably a balance between those two. So
yeah.
no, that was a good
We got to
answer.
dig in and understand why. I mean, it can't always just be poor management, right? There has to be other reasons too sometimes. So, I mean, it's important to have those conversations, but happy to have them with people but hope that kind of shed some light to the individual.
Yeah. Thanks for answering. That's a tough
Sure.
one, but we do
No,
hear it a lot, right? That comes up a
no problem.
lot. So
You
that's
know me,
great.
I don't mind the tough questions. So,
So this one's might be more for me. Says I know you guys aren't giving legal or insurance contract advice. However, based on your experience, would it be more simple transition, especially in a family business, with insurance contracts to purchase over a 2-year period rather than doing a complete change of ownership? Because then you would only have like a 20% change and then a
mm,
20% and then a
mm.
20%. Um,
You want to tackle that one first, then I'll chime in.
yeah, so simpler is probably the wrong word. So uh, yes, if you do minor changes to ownership, you don't have to do as much with the PBMs. However, like eventually you need to update them that you're an owner. So you are going to do it at one point. Um, so I wouldn't delay your full ownership change because of insurance contracts. I would make the decision of how you're going to transition the business, especially in a family situation, based on conversations and what's best for your family in the business. Insurance contracts are a second piece to this. You can change them over. Do you got to fill out paperwork and do all this stuff? Yes. Is it a pain? Yes. But you're going to be filling out paperwork, right? So if you do a 20% ownership change, when the recredentialing comes, you got to tell them.
Mm,
So like you're filling it out. So like I make the decision based on what's right for you, the business, for your family, like structure it like we just got done talking about here. Structure it in a way that makes sense for everyone and then deal with the insurance contracts. We deal with these things all the time. I mean, insurance contracts are part of what we're doing every day. You can get them transferred over.
yeah,
Now, the structure of the deal might matter. In some areas, you may need to do a stock sale or whatever, but like,
yeah.
yeah,
Yeah, I think as it relates to the insurance plans, just high level, the asset versus stock entity and entity changing or not. Obviously, the percentage of the ownership change, but I agree with you. I think even though we think sometimes the insurance is that's the tail that wags the dog. I think you need to kind of think about a little bit to your point about what's best for the business, what's best for the transaction, determine that, and then you can have conversations with the PSAO or the PBMs about what might occur, get legal advice in that way.
yeah, no, exactly. Has there been any changes to collateral requirements with the new SBA program?
Great question. No, unfortunately, there has not. The primary collateral is always going to be the business, right? The entity. So that kind of gets into like borrower, co-borrower situation. The guarantees are always going to be same thing, 20% or above, or meaningful individual as determined by the bank. And then secondary collateral, the biggest one in the SBA world that gets a lot of people questioning and more conversations are the secondary collateral requirements if an individual who's a guarantor on the loan has 25% or greater equity in any personal residential, commercial, secondary home stuff. So that's something that you just have to have, when you fill out a personal application or a personal financial statement for a bank, you list your assets and liabilities and you list kind of what you own personally. And then along with sometimes if you are existing owner of the business, what you might own there in properties. And so you're going to have a conversation with the lender about, hey, what's on the table, what's off the table with that, and where that falls.
Yeah, great. Man, we have some good questions here.
Sure, good.
So I love this one. As a single store owner, what is the minimum net worth balance sheet goal should I have when I'm considering a second location?
That's a great question. I would say
Yeah.
9 to 1, 9 to 1 debt to worth. That's the first thing you want to consider. And then, the great part about it is that if the cash flow meets it, if it's in the same regional area, geographic area that makes sense and eligible, you could be eligible for up to 100% financing because it's going to be an expansion to the question, right? So
Yeah.
that's something that you have to look at. But I would say that's a really good, uh, uh, point on the balance sheet. I would say 9 to 1 debt to worth.
Yeah. And cash flow
Yeah, yeah, right, right,
for your current store. That's also
right.
helpful. Um, let's see. What are the typical terms of a seller note after the 24 months of standby?
Great, another great
I mean, I'm
question. So
telling you, these are
yeah,
great
after
questions.
24 months, it's really going to be up to what the cash flow supports. Remember, you can't have a balloon payment. But whatever the cash flow supports, buyer seller can agree upon that as long as it meets lender requirements, it meets cash flow requirements.
Okay.
So hope that answers the question. And you can work with the lender to kind of sketch out, help people say, hey, we're thinking of this. Can it work on that? Does the historical cash flow support that? Does the current cash flow support it? So that's something that can be discussed, and again, another good reason why to engage that lender early on.
Uh, what time after initial opening of a pharmacy can I request an SBA loan? So I'm assuming that this person opened it without any loans, which is
Mm.
good.
Mhm.
Yeah, is it
Um,
time or is it more cat? Well, I mean, you probably need a tax return, right? That's like, I
yeah,
don't
it's a
know.
little bit, I would say, the boilerplate answer is probably going to be 1 year, right? So that way you can show 1 year of financials, 1 year, and you have a tax return. Um, y- I can't speak for every bank out there, but sometimes there's an individual who backfilled the store and just for whatever reason, 6, 7 months, 8 months into the whole thing, they're filling 300, 400 scripts. I mean, we've seen that
Yep, yep,
with one of your clients
yep,
actually.
yep.
And so in that way, that's a very unique situation. So, but I would say boilerplate's going to be a year. But listen, if you fall under a unique situation, don't hesitate to pick up the phone and talk to somebody about it.
Great. Okay. Those might be some of the best questions we've ever had on one of these. So I think that's all the questions. Any parting words for us? And how can people get a hold of you?
Uh, Thank you again for having me. Always excited to do these. Look forward to doing some more of these as the year goes on. You can follow me on LinkedIn. You can reach me via my email address. I'm happy to type that in the chat here. For people, greco.devalencia@liveoak.bank. You can find me on the web as well. And I look forward to seeing everybody here coming up as we enter into, pretty soon, trade show season.
Yeah,
And just wish everybody a good 2024. I know it's hard. Good news are, I think there's going to be some relief, especially around the interest rates. Hopefully those will start dropping pretty soon too. And look forward to helping have good conversations with people.
yeah. Thanks again, Greco, for the time and hopping on and answering everyone's questions. Again, you can find us at independentrxconsulting.com. You can also follow us on LinkedIn. We are recording this, and it will be pushed out probably in the next day or two, depending on how long it takes us to clean it up. Thanks for your time, and we'll see you on the next one.
Thanks a lot, Owen. Bye,
Yeah.
everybody.
Thanks. Bye-bye.